What's up, guys? Welcome back for another round here. I already recorded this video once, but we had some serious technical difficulties. And so here we go for round number two. Let's see if this works. Today, we're talking about why the US economy will crash. Now, before I dive directly into that, I want to refer you back to a few videos that I did a while back. And these are called Where Does Stimulus Money Come From? Why does the government pass stimulus packages? How to survive a recession? Assets that will make you rich in 2021? And will we have inflation in 2021? So if you didn't watch those or hear those on the podcast, I'd recommend going back and taking a look. I detail out some interesting things in those that show where the money comes from when the government prints money or distributes stimulus packages, things like that. How's that money created? What effects does it have? Who gets the money? Those kinds of things. And then now I predicted in some of those videos that we would have inflation. I also predicted that the stock market would go up. Now, that's not me being a genius. That's simply me listening to the brightest minds that I can find in the investment world. Ray Dalio being the number one authority, in my opinion, but Warren Buffett, Kathy Woods, Michael Burry. So there's a long list of big time hedge fund managers, economists, etc. And these people pay hundreds or thousands of employees millions of dollars to stay on top of this stuff. So that's the easiest way for me to also stay on track, right? If you can't beat them, join them. Those are the people you cannot beat, and you might as well follow. So I try to stay on top of that, and it has turned into me making a lot of money in this time of turmoil, and now things are getting crazy. Okay, so we're going to jump into that, but I wanted to refer you to some of those previous videos, and you can see the patterns that are going on and where we're heading. So the first thing that I want to mention really quick is in fact a Ray Dalio video called How the Economic Machine Works. It's like a 20-30 minute YouTube video that is the best simple economic demonstration that I can think of. You'll get more from that single video than you will from an economics 101 course in college. That video depicts exactly how money moves, the impact it has, the impact that the Fed has, the central banks, the people, how one person's spending is another person's income, and that person's income turns into their spending, which is another person's income, and so the cycle goes. The economy is running on credit mostly, far more credit in the economy than actual cash, right? So this shows all those components, and I'm going to hit on a few of them here in more detail just to show you the critical points right now. But I would definitely recommend you go take a look at that video. Okay. So, number one, let's start with the interest rate. The interest rate is the government's single greatest tool to stimulate the economy. So, when we start talking about recessions, a time when the economy's slowing down, we're having a difficult time, their spending is restricted, the prices are going up, whatever's happening, and people have to really tighten the belt in order to make ends meet. And when we all find ourselves in that situation at a large scale, the economy really struggles and slows down, right? People stop spending, therefore people earn less, therefore they spend less, and so on. The cycle goes. So we all tighten the belt across the board at the same time. The economy struggles and we come into a recession. Well, how do you pump more money into the economy? The simplest way is to let people restructure their debt, because human nature is such that we spend all we have and then some, right? If we have access to credit, we'll get it and we'll spend it. Now, if you use credit for something like, you're a business owner, you take that loan, you turn around and use the money that you've borrowed to purchase, new employees with new equipment. You give, if you're in the tech industry, you buy computers and the equipment you need to develop new applications and softwares and et cetera. And then, turn around, buy, pay some salespeople to go market it. And in the end, you get more money back than you borrowed and you can pay your debt. However, not everyone spends it so wisely. A lot of people borrow money on credit cards or HELOCs or different, refinance their house and go buy a car and buy a TV and buy a vacation. Well, the car is useful in that it gets you to point from point A to point B, but it is a depreciating asset. The TV, 100% depreciating asset. The vacation, while it may have a moral boost and some things that do well for you and your family, it's not an asset in a business sense, right? So all that it dissolves and you still have the debt. And so once people's debt burden gets too big, they have a hard time spending more money. Thus, the economy slows down. So if you can offer them an out by helping them restructure their debt and get some leniency in their budget, spending goes up. So let's take a look at the federal interest rate. I'm going to show you this chart and show you how this has worked. So here we are looking at the federal fund rate, which is the interest rate. Okay. This is the rate that banks are paying the government essentially. And then the bank can turn around and loan you money for a couple percent interest points above that. And they can make money off of that as well. So this is the federal fund rate. So you can see that this chart goes all the way back to what, the 1950s. The interest rate was very, very low and it climbed over time, right? And so in the 80s, we have the highest point, if I can get my cursor on, is about 20.6%. I'm not sure if that's the very max, but somewhere in that area. And essentially, since the early 80s, anytime we've had economic stress, we just decrease the interest rate. So take this into the context of the things I just described, where when a person or people at large scale start having to tighten the belt because their debt burden has become too big. And so they basically have to really get on a tight budget just to make ends meet, pay all their bills. Well, what happens when the government drops this interest rate from, here we are at 14% in the early 80s down to 9%? Well, suddenly everyone can refinance their house, refinance their cars, refinance everything, and they get all the same stuff for cheaper payments, and they got all this extra money, right? And so they start spending, 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 and eventually that debt burden gets too big. And so look, here we are in 1984, the interest rates somewhere in the 10s and 11s. The government decreases that interest rate over a couple of years down to 5 and 6%, right? So everyone gets to restructure their debt again. They can spend more money. The economy is stimulated, right? Government's trying to increase their debt again, the interest rate, but they only get it up to about 9.5. And then we come into economic struggles and we decrease the interest rate to stimulate the economy to 2.9%. They creep it back up. Okay, the pattern repeats over and over and over. 2008, we bottomed it out. We hit 0.11. There it is. So that might be the lowest, 0.08% in 2011. So we essentially hover just above 0% interest rate for several years. And then they finally start trying to put that tool back in their toolbox by hiking the interest rate in 2016 and 17. In 2018, we hit 2.44%. And then what happens? COVID hits. So they pull that lever again and they bottom it out at 0.09%. So when you look at this period here between 2008 and where we are today, we've spent basically 10 out of the last 12 years, or even 14 years, um, at essentially 0% interest rate. So when we are already at or near 0% interest rate, the government cannot free everyone from their spending and debt burdens by allowing them to restructure their debt with simple decrease of the interest rate. That tool is no longer in the bag, right? So the government then goes to printing money. But I want to just show you this. They're trying to hike it back up like they have historically. But look, we always have lower highs and lower lows as we go down. Just the exact opposite of the stock market and debt cycles where you have higher highs and higher lows. In this situation, we have lower highs and lower lows until we get here. Where can we go? Negative interest rates? That is possible, but it has consequences, right? So The government's trying to hike the interest rate back up. So my concern is if over the last 10, 12, 14 years, people have restructured their debt, at least the primary economic spenders in the economy today have already restructured their debt for essentially the lowest interest rates they could possibly get. Well, even if the government manages to put this tool back in their tool bag, get this up to 2, 3% interest rate, and then the economy's struggling too much, they've bottomed it out again at zero. How much is that actually going to stimulate the economy and how long will that last? I don't think it's going to go well. I don't think it's going to be long enough. I don't think it's going to be effective. And so we are essentially by the interest rate metric at our wits end here with economic stimulus, at least using this, right? Can no longer restructure debt. So, how do you restructure debt when the interest rate is at zero? Through the form of bankruptcies and things like that. When you look at this chart and you correlate it with the increasing gap between the rich and the poor, the haves and have nots, that gap has been widening over time, right? So that also causes conflict. The poor want more, the rich want to be paid their dues, right? Because they're the lenders. They want people to pay their debts and give them that asset that they own. Um, but the poor can't pay it. So conflict happens, right? Government has to step in. Sometimes we have war, different things. And this can happen at a country or global level as well, right? There's certain countries that cannot any longer pay their debts. I mean, look, the US owes a lot of money to some emerging economies like China. What might happen, right? Who knows? There may be war, there may not. So, this cycle you need to pay attention to. This is not the first time that this cycle has happened. Ray Dalio's team, they went back and studied history to see where these things have occurred in the cycles that happen, right? We're going to go back about 500 years and start with like the first stock market in Amsterdam. The Dutch were the great ship makers and traders in the world, right? And they had sort of the best reach to other countries and locations with their with their sailing and ship making and all this. And so they create the first stock market. People can put their money into these companies. Anyway, the economy thrives. It's the financial center of the world. Well, when people get rich, they tend to pay other people to do the hard work that they used to do. So they start paying others. They pay English to build the ships, etc. Right? They go through this whole cycle with debt burdens and spending and all this, and their financial markets collapse. They hit a breaking point, and there's conflict. There's all kinds of things, and out of the ashes rises London as the new financial center of the world. England is the most powerful country in the world. They're very wealthy, etc. They thrive, and come World War II, right? Uh, Conflict, financial centers collapse, etc. Out of the ashes rises the United States, and New York City becomes the financial center of the world. Well, we're in that cycle again. We're at the end of another era. This is what Ray Dalio would call a long-term debt cycle is now on the downfall, and the emerging economy seems to be China. Now, we're only halfway through this, so who knows what kind of conflict may arise, what the restructuring of debt might look like, and how much longer we can kind of drag this out, right? Uh, I don't know for sure that this is going to happen immediately, but it seems like we are pretty much hitting the breaking point. Um, we're already starting to see struggles in the economy, even though it feels like it's thriving. People are still spending money at an alarming rate, right? Everyone seems to have money. Everyone's buying bigger houses, buying new cars, millionaires everywhere. But there's supply chain issues. Gas prices are going really high, really fast. Food prices are going up, all these things, right? So, how long can the poorer class live on those standards, right? Okay, so to illustrate this income scenario that I'm talking about here, I want to show you this chart of real average household income by quintile. And then there's one more line that is the top 5%. This goes up to 2020 by quintile. So we're talking about fifths of the market. The very top quintile uh, seems to be growing their wealth fairly rapidly, right? Um, Now, when you look at this chart from 2019 to 2020, they actually had a negative 1.6% increase. But as you know, that in 2021, that went crazy, and the richest people in the world got super rich super fast. The top billionaires in the world made tons and tons of money over 2021, right? But that was not the case for these, second, third, fourth, fifth quintiles. Now, maybe the second did okay. I think, people that had a 401k and a house and those kinds of things, they probably had a net worth increase and possibly annual incomes increased, but not like the super rich. And then really things get hard when you start looking at the middle, fourth, and bottom quintiles, right? Their incomes have not been growing over time. 2021 was not their friend because these people don't own a lot of assets and their incomes are not that big. So we're talking about people who have about $60,000 a year income or less. See, this middle quintile here has a $69,000 year income, and it went down 2.8% in this, from 19 to 20. The fourth quintile went down 4.1%. The bottom quintile went down 5.7%. And then, like I said, in 2021, the super rich got rich, but the bottom did not, right? So when we're looking at this chart, think to yourself, like, how much of these gas prices can these people afford? How many times can they go to the pump and pay 5, 6, 7, $8 per gallon? How many expensive gallons of milk can they buy and avocados and whatever, right? Like, if they can't afford to pay for these things, then what happens? Conflict, right? Conflict ensues. Okay, so conflict ensues when these people can no longer afford to live their lives at the current rates that they're dealing with, right? Okay, this happens on a federal government level as well. So I want to show you that chart. Okay, so this chart shows debt as a percentage of GDP. Okay, federal debt as a percentage of gross domestic product, which is a gauge. GDP is the gauge of how much money our economy is producing overall, right? It's a complicated thing to try and gauge, but they've they've done a decent job. So in the 60s, 70s, 80s, we're talking about it's only, 30% up to as high as 40% in 1966 of GDP. The debt is only 40% of GDP. In the 80s, it starts to climb, right? And it's getting up there 60%, 65%. And then here's where it starts getting crazy. 2008 crisis happens, and the percentage of debt to GDP spikes in basically 2 years to 80 plus percent of GDP, and it continues to climb all the way to 2013. We start to level out around 100% GDP. Can you imagine that? What if this was your personal scenario and you had as much debt as you have income? That's pretty rough. It's hard to pay. And then we spike it in 2020. We get to 135% as a percentage of GDP. It's dropped slightly, so we're still at 124 and 25% of our GDP. So our government is in as big a trouble as any individual. Their finances look like the bottom quintile of that graph I just showed you. So the government is in no position to bail anybody out. So how does the government deal with their debt? Well, go back to some of those videos I talk about where stimulus money comes from and the actual details of how they actually create money and sell bonds and all these things. But essentially, they print money and they hand it out, and inflation is good for the government, right? So they can inflate away their debt to a degree, right? So they print money, devalues the amount the dollar is worth. They can pay their debts because now they have more dollars and the fixed debt stays at its value, but they have more dollars that are worth less, so they essentially throw that at their debt. But that is not consequence free. That is where we're seeing inflation all over the place, right? Now, I have heard, and I had a hard time trying to verify these things, but I heard Patrick Bet David say that 40% of all money in circulation today has been printed in the last like 2 years or something like that. That the government has printed about $8 trillion since the pandemic started. So I don't know how perfectly accurate those numbers are, but they are somewhat accurate. They're pretty close because the government has been printing money at an alarming rate. And some people predict, 30-40% inflation over the short term. So this could be rough. Okay, so you start to put all these things together. The government has printed tons of money. They no longer have the interest rate as a tool in their bag to stimulate the economy, to restructure debt. They themselves, as a federal government, have a massive debt burden. So it's not like they can just accumulate more debt, print money and pass that out to the common person and sort of use that tool that they've used since 2008 at a crazy rate. So, and now also each individual out there has a large debt burden. Now, the last thing I want to talk about the debt burden is if you have a large debt burden and you're starting to feel restricted, and everyone feels that at the same time, or at least a lot of people feel that at the same time, they restrict their spending. My spending goes down means your earnings go down, means your spending goes down, means the next person's earning goes down, right? Everyone does that. Well, guess what? What if you had $50,000 of debt and $100,000 a year income, and all this turmoil causes a lot of job loss, etc.? Well, now you find a job that pays $70,000 a year, but you still have a $50,000 debt burden. It feels exponentially worse to deal with than it was before. And when we have that at a global scale, it's like the nuclear bomb went off and we have real problems. That's when we start to see deflation. So even though everyone's expecting crazy inflation, it could go to the point of driving deflation, and everyone's got products to sell, but nobody can buy. So products get cheaper, 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 cheaper. Your house will be devalued. Your cars will be devalued. Food, everything's going to come back down, but nobody can buy it because no one has money. So that's where we have a Great Depression. And it's got to happen at some point. But that's where I say I'm not sure if the government can put enough tools back in their tool bag to drag this out, another 10 years. Like a lot of people thought this scenario was happening in '08, and the indicators said it should have, but we managed to, you know, squeak it out, and the bailouts worked, and certain debt burdens were relieved enough that we got through it. But now we've been coasting at 0% interest rate for 12, 14 years. So can we do it again without that tool in the bag? I just don't think we can. And even if we do pull that lever again, it'll be short lived, it'll have minimal effect, and we're headed truly into a Great Depression. So, this is why the US economy will collapse. I think China will probably rise out of the ashes as the new financial center of the world. That doesn't mean that the U.S. economy will go away completely and you won't have a job and you'll never, do well again. Look at all the other places, Amsterdam and England and all these places. They're still doing fine, but it didn't come without hardship. It didn't come without a massive recession or depression. When you look at like the stock market charts around the depression, prior to the depression, it was climbing, climbing, climbing. It was like one of those things like just get in because it's going up, get in because it's going up, right? And then just prior to the depression, it went crazy huge gains, massive spikes, and then a massive drop far past where it was. And the market did not see new highs, meaning higher than its last highest point for decades. And so we may see that same thing. We had that massive spike. It seems to be falling, probably going to fall more. We might see some ups and downs before it just completely crashes. But if it ends up dropping by 40, 50, 60, 70, even 80% before it starts to turn back up, that upturn is going to be slow. It's going to be drawn out. We won't see new highs for probably decades. So that's where we are. And I hope this video helps you understand what you should do to to get yourself ready. A quick blurb on that, I would say, make sure you've got some cash to survive joblessness or increased prices, things like that. Get your portfolio that is invested diversified across asset classes, competing assets, as well as countries, so that you can kind of get, as one sector goes down, the other goes up, and you sort of balance that. You capture real growth, and you don't just have all your eggs in one basket, because things are chaotic right now. And when people move money, that's when things go up and down. And so the people that really control that are those who have massive hedge funds, right? And so when they move billions of dollars, markets are affected. So and since you don't know where they're going to go and what they're going to do, you want to have a nice balanced portfolio at this time, because this is not really a time where you go, you know what, I think Microsoft looks good, I'm just going all in on Microsoft. Because if Microsoft has some unexpected thing happen, it could tank. You're going to see a lot of companies that you think are really, really, really secure fall apart and go away. You might see some other ones rise out of the ashes as like some new powerhouse company. It's going to be a lot of changes coming forward. So anyway, I'm selling my second home and gonna spread the money out, keep a little cash, and brace for impact. It's coming. Anyway, thank you guys for listening. I hope this has been valuable to you. If so, hit the subscribe button, hit the like button, share the content, help me reach a broader audience. I appreciate your support, and we'll talk to you on the next one.